All right, listen up everyone, and welcome to today's Explainer. I'm Steve. Go ahead, grab your coffee, pull up a chair, and let's get straight into it. Today, we are breaking down a massive, high-volume rocket ship ride on the tape. And look, the market didn't just stabilize here, it extended this violent, multi-asset short covering squeeze that completely rewrote near-term resistance. Now, while the mainstream news is out there scrambling to chase the green bars, our job on this desk is simple. We track the hard numbers, we stay disciplined, and we analyze the exact mechanics that just shifted all this capital. Let's open the ledger.
So, we're stepping into the regular session, and the broader markets are undergoing an absolutely intense technical realignment. June contracts are heading straight into expiration week, but the overriding theme, the real story here, is the fierce positioning happening during the Fed's pre-meeting blackout window. Last week, PPI printed at a sticky 6.5%, right? And because of that, options desks are paying up big time for protection against the higher-for-longer policy tone. Yet, if you look at the equity desks, they are completely ignoring that hawkishness. Instead, we're seeing this violent structural volume shift straight into the active September contract. That sideline capital, it is returning with a vengeance.
Looking directly at the settlement board, the bulls just took the wheel and stomped on the gas. Shifting over to the active forward cycle, September S&P futures, ticker /ESU26, exploded higher to lock in a settlement right at $7,497.50. Moving down the board, spot gold staged a powerful recovery, surging nearly 3% to north of $4,336. And Bitcoin? It caught a massive risk-on wave, vaulting over key thresholds to trade up around $66,628. But you gotta look at the outlier at the bottom there, Brent crude, a massive 4.77% bleed. To understand why equities and crypto flashed blinding green while energy just completely dumped, we have to talk about a massive geopolitical plot twist.
What is truly fascinating about this tape is the complete 180 in the macro script. I mean, for the last few weeks, programmatic desks were pricing in severe war risk premiums. They were terrified of a permanent supply chain lockdown in the Middle East due to those US and Iran naval tensions. But then, the White House confirmed a sudden de-escalation framework and frozen offensive operations, and boom, that script completely flipped. The very second that announcement hit the wire, it triggered a violent, massive unwind of defensive hedges across the board.
The crucial piece to grasp here is the actual mechanics behind that flipped script. We're talking about a classic mechanical short squeeze. See, when that de-escalation framework was announced, millions of dollars in short positions were instantly trapped on the absolute wrong side of the trade. Automated market makers stepped in and forced them to aggressively buy back futures contracts just to clear their books. That mechanical short squeeze, that is the exact, literal rocket fuel that sent equities vertical. I can't stress this enough. It wasn't organic buying. It was forced buying.
Let's jump over to the energy pits and see how this actually builds, because this is where the de-escalation hit the hardest. Crude oil went to a state of absolute freefall. The active July Brent crude contract collapsed a staggering 4.77%, plunging straight back down to anchor at 83.16. And why? Well, because market participants suddenly had to price in a full reopening of the Strait of Hormuz. All those deep fears of supply chain lockdowns, they simply evaporated into thin air.
And this brilliantly illustrates the broader economic impact. This total collapse in the oil premium effectively acts as an immediate corporate tax cut across the entire S&P 500. Think about it. Lower input costs and cooling logistics mean corporate profit margins instantly expand, which completely offsets last week's hot 6.5% inflation print. The fact that oil bled out while S&P futures skyrocketed totally confirms the macro release valve is wide open. It gives equity bulls the perfect fundamental justification to hold on to these higher valuations.
Pivoting over to the tech and crypto desks for a second, we saw an equally critical structural shift. While energy fell, the heavy macro liquidity that had been drained over the past 2 weeks officially returned. Wall Street had been hoarding cash blocks, just waiting to participate in the historic SpaceX IPO debut on the Nasdaq. That event vacuumed up market liquidity for a massive $1.77 trillion capital raise. Trillion with a T. But with that hurdle now cleared and the stock soaring on day one, that liquidity drain is officially over.
Let's just trace the flow of that sideline capital, because it's a beautiful thing to watch. Step 1, the historic SpaceX IPO clears the decks. Step 2, all that hoarded cash unlocks. Step 3,
Institutional capital floods right back into large-cap risk equities and digital assets. Over in crypto, this capital re-entry allowed Bitcoin to easily absorb the hot inflation data. Buyers aggressively defended the floor, and the moment short sellers realized that demand zone wasn't breaking, automated stop losses triggered, pushing Bitcoin right back up to that $66,628 level.
Okay, so what does this all mean for us? How do we actually trade this? First off, stop chasing the highs of a green rocket and start trading the hard-moving averages. This right here is your professional trading blueprint. Checking the September S&P Futures/ESU26, today's extension to $7,497.50 means price action has aggressively reclaimed its daily 20-day simple moving average. But actually, more importantly, it firmly defended our primary structural anchor, the upward-sloping 50-day EMA. As long as it holds its ground right here on a weekly closing basis, this primary bull market is structurally protected and wide open for further upside expansion.
Now listen to me. We are heading into a critical Fed week, and you absolutely cannot let FOMO make you sloppy. You need strict discipline right now. Keep your eyes pinned to the crude contract at 83.16. If energy stays suppressed, it clears the runway for the equity bulls ahead of the highly anticipated FOMC meeting. But you must follow these directives. Respect your stop losses, manage your position sizing, and above all else, let the hard numbers dictate your execution. Do not, I repeat, do not let emotion drive your trades this week.
I'm going to leave you with this final hard-hitting thought. The setup is there. The capital has officially shifted, and the structural anchors are clearly defined. The ledger doesn't wait for latecomers, folks. Are you ready for the morning bell? Thanks for joining me on this explainer today. Stay disciplined out there, keep your emotions in check, and I will catch you on the next one.